The idea of a company trading well below $1 and quietly building foundational technology for tomorrow's computing ecosystem may sound counterintuitive to many investors. It's a story that doesn't hit the headlines like the latest mega-cap chipmaker, yet it matters just as much beneath the surface. When the market's gaze is fixed on the giants of AI hardware, there's a quiet revolution happening in the infrastructure that underlies advanced wireless computing and next-generation connectivity. In this video, we explore why one very small company trading at roughly 18 cents could be operating in a space that matters to the future of computer chips and why that narrative deserves attention even if it doesn't make headlines. This topic matters at this particular moment because we are living through a period of extraordinary technological evolution. The wave of artificial intelligence adoption is reshaping not only software but the very hardware on which it runs. What used to be a linear progression of faster processors and bigger integrated circuits has become a multidimensional arms race for specialized hardware that can support AI in real time, at the edge, and in environments where latency and efficiency are critical. Investors familiar with behavioral finance know that markets tend to overprice the obvious and underprice the subtle. Those companies quietly building the bridges between aspiration and application often suffer from a lack of attention until their relevance can no longer be ignored. Looking at the broader industry, the semiconductor ecosystem is no longer just about central processing units or generic graphics chips. The era of specialized AI accelerators, system-on-chips optimized for machine learning workloads, and chips designed for communications and connectivity has taken hold. Edge devices, self-driving systems, augmented reality platforms, and smart infrastructure all depend on components that can do more with less. Less energy, less space, less latency, while maintaining the integrity of complex computations. What this means for the industry is that innovation isn't just coming from a handful of legacy players. Smaller, more focused firms are carving out niches that support the broader architecture of the AI-powered world, and those niches can be the unseen backbone of future growth. Within this evolving landscape, there are many layers of specialization. Some companies focus on memory architectures, others on power efficiency, and still others on the algorithms that drive machine learning. One layer that often gets overlooked is the hardware link between computing and communications, the chips and systems that allow data to move quickly, efficiently, and intelligently between processing units, sensors, and networks. These are not the chips that grab headlines, but they are the chips that must work flawlessly if devices are to scale beyond research labs into real-world deployment. This niche is where innovation meets real demand, and this is the environment in which the subject of today's deep dive operates. For years, investors have been taught to look for the companies with the flashiest prospects or the biggest marketing presence. But in the world of hardware innovation, execution, precision, and integration matter more than flashiness. The companies that succeed at the infrastructure level are those that can prove utility in multiple environments, demonstrate interoperability with existing systems, and help reduce bottlenecks that have emerged as AI and connectivity demands have grown. It's a subtle but profound shift in how the industry allocates capital and attention, and it's exactly this shift that opens the door to undervalued opportunities that are out of view for many mainstream market participants. To understand why a company with a very low share price might be operating in such a space, it helps to look at how innovation ecosystems function. Early-stage technology plays often develop highly specialized solutions that are initially appreciated only by a small group of engineers, partners, or early adopters. Over time, as these technologies go through iterations and demonstrate tangible performance gains, adoption begins to broaden. Only at that point does the market begin to reassess the underlying company's true relevance. This delayed recognition can create asymmetric opportunities for investors who are willing to pay attention to the structural shifts rather than the loudest stories. Now that we've laid the groundwork and explored how the industry is evolving, it's time to introduce the company at the center of this discussion. The firm we've been talking about quietly for the past few minutes is Mobix Labs, trading under the ticker MOBX at a current stock price of approximately 18 cents. While the company's market capitalization is small and its name may not be familiar to the average investor, the technology it is developing sits at the intersection of advanced wireless chip technology, signal processing, and next-generation computing infrastructure. These are the elements that support connectivity, data throughput, and low-latency communication, all of which are critical in an era where distributed intelligence and edge computing are becoming essential. If you enjoy in-depth research-based analysis that goes beyond the headlines and explores the deeper currents shaping technology and markets, consider subscribing and turning on notifications. Content like this is focused on putting the pieces together so you can see where real innovation is taking place, and we aim to explore similar opportunities regularly. Despite the compelling narrative around the technology and its relevance, the stock remains inexpensive by most conventional measures. This discrepancy between operational relevance and market valuation can be explained in part by a lack of broad visibility. Smaller technology firms often operate under the radar, receiving limited coverage from analysts and minimal discussion within mainstream investment communities. Institutional investors are generally focused on larger cap names with more liquidity, which means that smaller, specialized companies can remain unnoticed for longer periods. This creates a challenge for the company in terms of market recognition, but it also represents the very dynamic that sometimes precedes significant valuation change. Another factor that keeps smaller technology stocks priced low is execution risk. Investors often apply a discount to companies that have promising technology but are still in the early stages of commercialization or scaling. This is a rational response on the part of the market, as scaling complexity, manufacturing challenges, regulatory environments, and competitive pressures all introduce uncertainty. Yet, it is precisely this gap between narrative potential and market pricing that attracts attention from long-term investors who study adoption curves, industry integration, and real demand signals rather than price action alone. Looking forward, the potential catalysts for a company like Mobix Labs could take several forms. Continued advancement in wireless communication standards, expansion of edge computing applications, partnerships with hardware integrators, or adoption by enterprises seeking more efficient data pathways could all serve to elevate awareness and relevance. If the solutions being developed can demonstrate consistent performance benefits in real-world deployments, the broader ecosystem may begin to incorporate them more widely. Market recognition often lags technology adoption, so investors looking through a longer time horizon may find that the early groundwork laid by such firms becomes increasingly apparent as demand grows. Of course, it is essential to address risk in any balanced discussion. Investing in small-cap stocks, particularly those with share prices under $1, can be highly volatile. Technology sectors move quickly, and competitive landscapes shift. A company's product must not only be innovative but also commercially viable and scalable. These are substantial hurdles, and not every firm navigating these waters will succeed. That is why understanding the underlying technology, market forces, and broader industry context is as important as any single metric or price movement. This narrative about a 18-cent AI stock quietly involved in building foundational technology for the future of computer chips is not about encouraging short-term speculation. It is about recognizing underlying shifts in how computing and connectivity evolve, and appreciating the roles that firms of different sizes play in that evolution. By focusing on technology relevance, real use cases, and industry integration, investors can develop a more nuanced view of where value may lie, even in places the market hasn't fully priced yet. As we wrap up, consider this: the companies that end up powering future technology aren't always those with the loudest announcements. Often, they're the ones meticulously engineering solutions that others depend on, quietly refining their approach until the broader market can no longer ignore them. Observing how these smaller players integrate into the larger ecosystem can offer insights that go beyond simple price speculation and into the realm of real, structural technological progress.